The American dream is beginning to feel less like a hopeful promise and more like a system built to trap you. You spend years saving, fight through intense bidding wars, and finally receive the keys. Then the unexpected expenses arrive: taxes, insurance, and various fees that can drain tens of thousands more every year. We're traveling across 10 states where this dream is falling apart the fastest, highlighting the financial pitfalls so you can avoid them. The real threat isn't only your mortgage, it's increasing taxes, vanishing insurance options, and hidden expenses that hit hard, even in Midwestern or mountain regions. If you're tired of being caught off guard, hit like and subscribe. Let's begin. Number 10 on the list is Nebraska. You open the windows and a breeze carries that familiar scent of soil and cornfields. Welcome to Nebraska, a place that feels calm, spacious, and almost free from problems. It's flat, quiet, and gives the sense that nothing too serious ever really happens here. The houses look sturdy, the lawns are well maintained, and at first glance, it feels like the perfect place for a simple, affordable lifestyle. At least that's how it appears on the outside, because beneath that peaceful charm, there's a financial system slowly wearing homeowners down. The real trouble here isn't the kind you see on the news. It's the property tax bill that quietly arrives in your mailbox and refuses to go away. According to a 2025 report from Wallet Hub, Nebraska ranks among the top 10 states with the highest effective property tax rates in the country. These rates can be nearly double what you'd find in states like Utah or West Virginia. For an average home priced around $300,000, that can mean paying more than $5,000 each year. That's about an extra $400 every month just to live in a home you already own. So why are the taxes so high? Because the state relies heavily on property taxes to support public schools, and those costs have been rising for years with little relief. Then there's insurance to consider. Living in the heart of Tornado Alley once felt like a reasonable trade-off, but recently things have changed. After several severe hailstorms and tornado outbreaks, insurance data shows premiums climbing rapidly. Some homeowners in Nebraska have seen their insurance costs increase by 20 to 30% in just the past year. It's not a dramatic or loud crisis. There's no mass exodus or urgent breaking news, just a slow, constant financial pressure that keeps building. People move here thinking they found a quiet, affordable escape from the chaos of coastal areas. But in reality, they've traded hurricanes for a tax burden that hits just as hard year after year. If you live somewhere in the Midwest, are you experiencing the same gradual strain from rising taxes and insurance costs? Share your state and what you're paying in the comments. I'd like to know what you're going through. Number 9, Oregon. As you travel farther west, leaving those endless flat plains behind, it suddenly feels like you've stepped into a postcard. The forests are so dense they seem to block out the sunlight, covering everything in a soft green glow. The air is filled with the fresh scent of pine mixed with damp earth. Honestly, it almost feels like a woodland creature could appear and offer you a mortgage. This is the version of Oregon you've probably seen all over Instagram, a lifestyle surrounded by nature and peace. It's marketed as an escape, a progressive, nature-rich haven far away from crowded cities and concrete skylines. You come across a small home hidden deep within the trees and think to yourself, "This is it. I've finally found peace." But then you try to get it insured, and that's where everything begins to fall apart. According to reports from the Oregon Division of Financial Regulation, the state is quietly facing a growing insurance crisis. After years of devastating wildfires, insurance companies have become extremely cautious, almost fearful. They now depend on stricter risk assessment models that can easily label your dream forest home as too dangerous to insure. In areas near Ashland and along the Cascade foothills, thousands of homeowners have seen their premiums double or even triple. Others haven't been as fortunate. They open their mail to find non-renewal notices, meaning their insurance coverage is simply gone. No backup plan, no safety net. You're left to handle it on your own. And even if your home never experiences a wildfire, there's another unavoidable expense: Oregon's state income tax is among the highest in the nation, reaching as high as 9.9%. Take a second to think about that. For every $100,000 you make, nearly $10,000 goes directly to the state. And that's before federal taxes are even considered. In many parts of Oregon, you're paying tax rates similar to California, but without earning California-level salaries. It's what some might call a paradise tax, the cost of living in a place this beautiful. You find yourself caught between two pressures: the very real danger of wildfires that could destroy your home, and the constant financial strain slowly draining your savings. So here's the real question: how much is too much? At what point does the price of living somewhere beautiful outweigh the peace you were hoping to find? Number 8. Illinois. As you enter Illinois, the landscape changes into a familiar pattern. Flat fields stretch out in a neat grid of small towns and farmland. The buildings feel solid and dependable, with brick houses that radiate a sense of stability and tradition. This is classic heartland America, the industrial core of the Midwest. You notice homes with tidy front porches and think, this is the kind of place where you could settle down and build a lasting life. But for an increasing number of people, it's actually the place where they start packing their things and moving away. They aren't fleeing natural disasters like wildfires or hurricanes. What they're really escaping is the heavy burden of taxes. When it comes to property taxes, Illinois is in a class of its own. According to a 2025 report from the Tax Foundation, it consistently ranks among the top 2 highest tax states in the country, alongside New Jersey. The average effective property tax rate sits at a steep 2.3%. That same $300,000 home, already costly in Nebraska, becomes even more expensive here, with annual taxes climbing above $7,000. In certain suburbs around Chicago, it's common for homeowners to face yearly bills of $10,000, $15,000, or even $20,000 for an average family home. At that point, it stops feeling like a tax and starts looking like a permanent second mortgage. People have noticed this trend. Recent census data and reports from moving companies like United Van Lines show that Illinois consistently has high outbound migration. Year after year, more residents are leaving the state than moving in. What's happening is a slow, steady population decline. The state's ongoing financial struggles force it to keep taxes high, which drives even more people to leave. As the population decreases, the tax burden falls on fewer residents, pushing rates even higher. It's a vicious cycle, a financial downward spiral that's difficult to escape. Buying a home here isn't just about the property itself. In effect, you're also assuming part of the state's massive financial obligations. A house may seem affordable at first, but the cost of living in Illinois tells a different story. If you've lived in Illinois or recently moved away, does this match your experience? Do you think high taxes are the main reason so many people pack up and leave the state? Number 7, New Jersey. As you merge onto the turnpike, everything immediately feels tighter and more compressed. The lanes narrow, houses sit close together, and there's a constant pull from 2 massive cities, New York City on one side and Philadelphia on the other. This is the ultimate example of location, location, location. You're within easy reach of careers, culture, entertainment, and the coastline. You spot a charming colonial-style home in a town known for excellent schools and think, I've made it. In a sense, you have. You've arrived in the state with the highest property taxes in the entire country. This isn't an exaggeration, it's backed by the numbers. Year after year, data from the Tax Foundation shows that New Jersey homeowners pay more in property taxes than anyone else in the nation. According to their 2025 report, the average annual property tax bill is approaching $10,000. And that's not for a luxury estate, it's the typical homeowner. On a $400,000 property, that works out to over $800 every month in taxes alone, comparable to a car payment or a student loan. But this one never goes away. It's like carrying an invisible second mortgage that only grows over time. Of course, you tell yourself it's worth it for the schools, the location, the proximity to the coast. But there's a catch. That coastline is gradually moving closer. Recent research by Climate Central shows that large parts of the Jersey Shore now face frequent flood risks. With rising sea levels and stronger storms, areas that once flooded once a decade are now seeing water in the streets multiple times a year. Naturally, this brings insurance into the equation. Flood coverage, when it's available, has become extremely costly. Changes from the Federal Emergency Management Agency, FEMA, have sharply increased premiums in several coastal counties. So now you're paying the highest property taxes in the country just to live in a home that could become waterfront property after one severe storm. It starts to feel less like an investment and more like a financial trap. So here's the question. If you're already paying $10,000 a year in property taxes, how much of a rise in flood insurance would push you to leave? $1,000 more? Maybe $5,000? At what point does this dream stop making sense? Number 6, Arizona. As you head southwest, the landscape outside your window transforms dramatically, almost like entering a completely different world. The lush green fields of the Midwest gradually vanish, replaced by vast red rock formations and towering saguaro cacti under a sky so vividly blue it almost seems unreal. Driving through Phoenix, you see rows of sleek stucco homes stretching for miles, each with neat gravel yards and sparkling backyard pools. At first glance, everything feels modern, polished, and surprisingly affordable. It's easy to see why so many people have relocated here. It looks like a permanent vacation at a fraction of the cost you'd pay in California. But then, as you turn on the faucet, a different concern begins to emerge. How sustainable is all of this? There's one challenge Arizona residents know about but seldom discuss: water. The state relies on an enormous engineering system that channels water from the Colorado River, turning desert into livable suburbs. However, according to 2025 projections from the U.S. Bureau of Reclamation, this critical water source has been pushed to dangerously low levels after over 2 decades of drought. And this isn't just a future problem, it's happening now. In some fast-growing areas, officials have even paused new housing developments because builders cannot guarantee a 100-year water supply. Consider that. You might not even be allowed to build a home because there's no certainty the water will last for the next generation. Then there's the heat, which is more than just uncomfortable. It's a serious challenge to daily life. Data from the National Weather Service shows cities like Phoenix repeatedly breaking records with dozens of days above 110 degrees Fahrenheit. Living here means running your air conditioning almost constantly for months on end. For many households, summer electricity bills climb into the $400 to $500 range. It's like paying a sunshine tax just to stay functional inside your own home. In many ways, choosing to live here means committing to a lifestyle that constantly battles the environment, relying on technology to maintain comfort while nature pushes back. So here's the question you must ask yourself. Does it make sense to invest in a home where water is becoming scarce and the climate increasingly extreme? Or is the lower cost today worth taking a risk on what the future may hold? Number 5, Colorado. As you leave the desert behind, you begin ascending into higher elevations, where the air is cooler, thinner, and noticeably crisper. Soon, the horizon opens up to the jagged, dramatic peaks of the Rocky Mountains. You drive into towns like Boulder and Golden, where the foothills shape a lifestyle centered around hiking trails, ski slopes, and a lively craft beer culture. This is the Colorado Promise, a way of life focused on health, outdoor activity, and having nature as an extension of your backyard. You spot a home with an amazing view. You decide it's worth the extra costs and convince yourself you've secured a slice of paradise. But reality arrives with a bill. The first shock usually comes from your insurance provider. After disasters like the Marshall Fire, which destroyed over 1,000 homes in just a few hours, insurers have become extremely cautious. According to the Colorado Division of Insurance, premiums in high-risk areas, especially those scenic mountain and foothill regions, have risen dramatically. Homeowners report increases of 50%, 100%, and in some cases up to 200%. In many situations, policies aren't just getting more expensive, they're being canceled entirely. Some properties are now deemed too risky to insure at any cost. Without coverage, obtaining or maintaining a mortgage becomes nearly impossible. That dream home with the million-dollar view can suddenly turn into a property you can't sell or leave. Then comes the second blow from taxes. Following the repeal of a long-standing tax-limiting amendment, property reassessments across Colorado have hit homeowners hard. Reporting from the Colorado Sun showed that in 2025, many counties saw property values jump 30 to 50% almost overnight. That means your home's assessed value soars on paper, and your property tax bill rises along with it. Even if your income hasn't changed, many residents face a sudden, overwhelming financial shock. You're already paying more for the view, and now even more for wildfire risk tied to that location. Add higher taxes on top of that because the same risky property is now considered more valuable. Just like that, the cost of paradise accumulates rapidly. We're only halfway through this road trip and things already look daunting. And if this seems intense, brace yourself. Upcoming states aren't dealing with potential risks anymore. In some places, the financial impact has already struck, and entire communities have felt the consequences. Number 4, Texas. The moment you enter Texas, everything feels larger than life, almost exaggerated. The sky stretches endlessly, highways widen, and there's an unmistakable sense of ambition in the air. Driving through suburbs around Dallas or Houston, you see seemingly endless new construction. Gated neighborhoods, large brick homes, and newly built schools line the streets as far as the eye can see. This is the Texas formula: minimal regulation, rapid development, and the promise of getting more house for your money. At first, it feels like a fantastic deal. A spacious 4-bedroom home here might cost the same as a tiny apartment in Denver. There's no state income tax either, making it feel like you've discovered a financial shortcut. But then the hidden costs start to pile up, and the picture changes quickly. The first shock often comes in the form of property taxes. Since Texas doesn't have a state income tax, it relies heavily on property taxes to fund services like highly rated schools. And those taxes are steep. According to the Tax Foundation, Texas consistently ranks among the top 5 states with the highest property tax rates. In many cases, the effective rate is nearly double the national average. That $400,000 dream home can carry an annual tax bill of $8,000, $9,000, or even $10,000. It's not a one-time expense, it's ongoing, and for long-time homeowners, especially those on fixed incomes, it can become overwhelming. Then there's the weather and the infrastructure strain. After the catastrophic power grid failure during the 2021 Texas power crisis, many residents realized how fragile the system is. The state's independent ERCOT grid operates on a nice edge during summer, when temperatures soar into the triple digits for weeks. Residents may be asked to reduce usage just to prevent widespread outages. On top of that, keeping cool comes with some of the highest electricity bills in the nation. Along the Gulf Coast, insurance adds another layer of concern. Major hurricanes drive premiums up, and deductibles, often a percentage of your home's value, can leave homeowners covering tens of thousands of dollars before insurance even starts to pay. So the question remains, is the no state income tax truly the advantage it appears to be, or one of the most persuasive financial trade-offs ever sold? Share your thoughts in the comments. Number 3, Louisiana. As you head east from Texas, the air immediately feels heavier. Thick, humid, almost weighted with history. The open plains slowly shift into bayous and wetlands, and the culture surrounds you instantly. Music, food, architecture, it all feels rich and captivating. Driving through a small town, you notice a beautiful, historic shotgun house for sale at a price that seems unreal, $180,000. With the equity from your Austin home, you could buy it outright. You start thinking, I could actually live here. This could be my home. But then you make a quick call to an insurance agent, and suddenly the dream falls apart. Welcome to Louisiana, a state often considered to have one of the most troubled home insurance systems in the country. After enduring a series of devastating hurricanes, Hurricane Laura, Hurricane Delta, Hurricane Zeta, and Hurricane Ida, the private insurance market has largely pulled back. According to the Louisiana Department of Insurance, more than 20 companies have either left the state or gone bankrupt in recent years. The few that remain are charging extremely high premiums. A 2025 report shows the average annual insurance cost across the state has climbed above $6,000. Along coastal areas, it can easily go beyond $10,000. That's over $800 a month for a home worth only $180,000. It essentially becomes a second mortgage just to insure the property. For many homeowners, the only option left is the state-run insurer of last resort, Louisiana Citizens. The downside? Their rates are intentionally set higher than private insurers so they don't compete directly. At that point, owning a home starts to feel less like stability and more like gambling in a system where the odds are stacked against you and where a single hurricane could erase everything. The house itself may be affordable, but the cost of protecting it has become nearly impossible to manage. So here's something to think about. If you were offered a free house in Louisiana but had to pay $10,000 a year in insurance, would you accept it, or would you keep moving forward? Number 2, California. You drive north along the Pacific Coast Highway, where cliffs drop sharply into the deep, ever-moving blue ocean. The sunlight hangs in a constant golden glow, bathing everything in warmth, and there's a clear sense of endless opportunity in the air. This is the California dream, polished, marketed, and sold at a high price. It's the cultural center of the nation, a hub for innovation, and a place where fortunes are built. You come across a home sitting on a hillside with views of canyons or the shimmering coastline, and it feels like you've reached the peak of the American dream. Then reality sets in. The house can't be insured. And this isn't some distant possibility, it's already happening. Major insurance companies like State Farm and Allstate have openly stated that they are either stopping or heavily limiting new homeowner policies, creating what experts now call insurance deserts across the state. According to 2025 data from the California Department of Insurance, hundreds of thousands of policy non-renewals have been issued over the past 2 years, leaving many homeowners without options. Why is this happening? The growing risk of wildfires has made insuring entire communities financially unsustainable for companies. Your only real option becomes the FAIR Plan, the state-backed insurer of last resort. But it's far from ideal. These policies are minimal, often costing 2 to 3 times more than standard insurance, while offering much less coverage. In many situations, they don't even include liability protection or damage from water-related events like the atmospheric rivers that frequently flood parts of California. As a result, you're paying a high price just for fire coverage, and then spending even more to insure everything else separately. All of this for a home that, according to the California Association of Realtors, has an average value exceeding $800,000. You're not simply purchasing a home, you're buying into a zip code that the financial system has effectively labeled too risky. You're paying a premium for a lifestyle the market considers high risk. When $1 million home becomes nearly impossible to insure, can it still be viewed as an asset? Or does it become a liability, no matter how stunning the view may be? Number 1, Florida. And here we are, the final stop. the grand finale. This is the state where every financial danger we've seen along the way, soaring insurance costs, climate threats, and crushing expenses, come together into a single, perfect storm. Florida isn't just the top of this list, it's a glaring red warning for the entire American housing market. Here, the American dream transforms into a full-blown illusion. According to the Insurance Information Institute, the average Florida homeowner is paying over $6,000 a year for home insurance in 2025. That's $500 every single month. And no, that isn't your mortgage. It isn't even your property tax. That's the price you pay just to stay covered by a company that's quietly looking for a reason to leave, leaving you exposed if a hurricane floods your street. It's a total market breakdown. Dozens of private insurance companies have already exited the state, forcing millions of residents to rely on Citizens Property Insurance Corporation, the state-run insurer. Originally intended as a safety net of last resort, it's now the only choice, and financially fragile. If a major storm hits and depletes its funds, every Florida taxpayer could face a special hurricane tax to cover the shortfall. Basically, you're paying the highest premiums in the country just to be first in line for a potential state bailout. It's a mathematically insane scenario. In this situation, your home stops being an asset and becomes a liability. It's bait in a trap created by the combination of nature and runaway market forces. So here's the question. Is this still paradise, or is it the most sun-drenched financial trap in the nation? Across this journey, we've learned that the sticker price of a home is often just the entry fee to much bigger costs. We've seen states trained by taxes, burned by uninsurable wildfires, and drowning in failing insurance systems. The true lesson isn't merely to avoid hurricanes, it's to read the fine print on tax and insurance bills, because that's where the real disasters hide. Did we miss a state headed toward unlivable conditions? Leave a warning in the comments and subscribe to avoid getting caught in the next housing nightmare.